There are a lot of videos out there about mortgage tips, tricks, or things to look out for, and a lot of them are super helpful. But I've noticed there aren't many videos that just walk you through the process from start to finish. So if you're one of those people that just wants to know what to expect as you set out on this journey, this is the video for you. Now I'll warn you, this is gonna be a long one, but again, if this is your first time getting a mortgage loan, it should be pretty helpful. Now, if you find this type of content helpful, please do me a favor by liking this video or subscribing to my channel. This is the main way I grow my business, and you can help me get this information out there to more people just like you that want to be informed on the process. Now, before we really dive in, I'm going to make a point of leaving timestamp chapters in this video description. That way you can come back to this video even if you're in the middle of getting a mortgage and jump right to the section that's pertinent to you. Now, to kick things off, every mortgage starts with an application. You go to a lender or a specific loan officer, which is what I am, and that person could work for a bank or a credit union or be a broker like me, someone that can shop loans across multiple lenders on your behalf. And you tell that lender that you want a loan. You fill out an application either online or sometimes over the phone, and you give them some documents to support your application. Now, these will be things like a copy of your driver's license, a couple months of bank statements, copies of recent pay stubs, recent W-2s, tax returns, things like that. The loan officer will let you know what specific documents they want to see. Then they're going to run your credit. Now, at this point, they should call you up and chat through everything they found on your credit report and in your file and let you know what types of loans they can qualify you for based on your application and the documents that you've provided to them. And this is also when they will give you a pre-qualification or pre-approval letter, which is meant to serve as evidence that you have been vetted by a lender and that realtors can build a deal around your financing and have confidence that the money's going to be there when it comes time to close the deal. Now, quick thing to throw out there, in general, if you go to a loan officer and they give you a pre-qual or pre-approval letter without asking you for some of those documents I mentioned earlier, the license, pay stubs, bank statements, and other documents, run away. Do not ask them about this. Don't second guess it. Just go find another lender immediately. If this is your first time buying a home and somebody's just willing to give you a letter, you do not want to work with them. There are many loan officers out there that are lazy, they don't care about people, and they're just looking to close their next deal, just like in any profession. So they hand pre-qual or pre-approval letters out like candy. You then take that letter to your realtor, start shopping for houses, find one you love, submit an offer on it. The offer gets accepted. You pay your thousands of dollars in earnest money and you're under contract. Then all hell breaks loose. That loan officer now has to backtrack and ask you for those documents that they didn't get from you at the start. And in some cases, they find out that you don't actually qualify for as big of a loan as they originally told you, or you don't qualify at all. Now you have to cancel your contract. You're potentially out your earnest money, everyone is out of time, and the sellers that took their home off the market, they potentially missed out on other buyers that could have made an offer during that time that you were in escrow. All because your loan officer was too lazy to vet your file before writing the pre-qual or pre-approval letter. It's a nightmare and it happens all the time, so just be on the lookout for it. And it can be really tempting to take a pre-approval letter from a lender for an $800,000 loan with a good interest rate, but if you didn't furnish all your documents beforehand, it can be a foolish move. Okay, so you've got your pre-qual or pre-approval letter, depending on where you live, and you got it the right way by giving a bunch of documents to your lender. Now what? Well, you need to give a copy of that letter to your realtor. That letter tells them that you've spoken to a lender, you've been vetted on your own income and assets, which you'll need for your down payment and closing costs, and that you're good to go. Then you shop. And you may notice that in this scenario, you've already spoken to a lender before you shop. That's very intentional. A lot of people go shop with a realtor before they talk to a lender. Now, in my opinion, that's totally backwards. And your realtor shouldn't be doing that with you, at least not if this is your first home. If you've never bought before and your realtor is willing to go look at a bunch of houses with you and spend a bunch of time before you have a pre-qual or pre-approval, that's a red flag that your realtor's probably pretty green. Most seasoned realtors would never invest a bunch of hours into a first-time buyer without a lender signing off on the file first, unless they happen to know the person and can really trust them. Now, it's too often that someone thinks they're ready to buy a house because they saw some videos like this and did their own math with chat or something else just to find out there's some nuance in their file that means they can't qualify. Talking with a lender and getting your pre-qual letter before you shop is a great way to avoid running into any issues like this. As you go out with your realtor and look at houses, you're going to find some you like, some you hate, and hopefully at least one that you absolutely love and can see yourself living in. Once that happens, you submit an offer. Your realtor will handle this part, but they'll consult with you on what the offer should be and how to present it. They may also talk to your lender to help kind of strategize. The offer will include a deadline for when the seller needs to respond to it, usually 24 to 72 hours. Now, around this point in the process, you're also going to receive something called a loan estimate from your lender. Now, depending on the lender, you'll usually receive your loan estimate either when you're getting ready to submit an offer or shortly after you're under contract on a home. Now, you can reach out to your lender, give them the address of a property you're looking at and the price you're thinking about offering, and ask them to generate a loan estimate even before you're under contract. And you can also request a loan estimate much earlier in the process if you want, even right after you submit an application. But the reason they're often generated once you have a house in mind is that the lender can use the property taxes, homeowners insurance estimates, and purchase price, HOA information, and other details about that specific home to give you more useful numbers. So the loan estimate is a formalized document that lays out the basic terms of the mortgage you're considering. And I have a whole video on how to compare loan estimates. So I'll put a link to that in the description. Now, that loan estimate will show you things like the type of loan you're getting, the length or term of the loan, the interest rate, whether or not that rate is locked or not, your projected monthly payment, and a rough estimate of the closing costs associated with the loan. And I want to emphasize the word estimate. Some of the numbers on your loan estimate will be exact, while other numbers are based on the best information available to the lender at that time. Things like property tax, homeowners insurance, title fees, prepaid costs, they may change as the transaction moves forward and more accurate information becomes available to your lender. And again, the loan estimate is the document you should be using if you plan on shopping around to compare multiple lenders. Don't just call 3 lenders and ask what's your rate. That's really going to only give you partial information, and really any lender wouldn't be able to just give you a rate based off of that request. That does not give you enough information to truly compare one loan and one lender against another. One lender may quote you a lower rate but charge you thousands of dollars in points to get that rate, and another lender may quote you slightly higher rate but have substantially lower fees. So you want to make sure that if you're going to shop around, you compare one loan estimate to another. Once your purchase offer is submitted, you wait to hear back from the seller. But if you're working with a good realtor and a good loan officer, they don't wait. They get into action here to help you win the house. Now, before my clients submit an offer, I try to get on the phone with their realtor and strategize around what they're thinking. Oftentimes, they'll ask me to call up the listing agent. So I'll give them a ring and introduce myself, let them know that I'm representing my clients on the financing side of this deal, this offer that's coming in, and I'll assure them that my clients have gone through a full pre-approval process, not the lazy process that I talked about earlier in this video, and that all the financing is in order. Also, depending on the specifics of the transaction, I'll let them know that the lenders I work with allow us to move lightning fast, and that with a clean inspection and appraisal, we can close in as early as 2 weeks. Again, depending on the structure of the deal and what your realtor wants. And I'll also tell that listing agent that they can expect loan status updates from me every week while we're in escrow, which is something that all realtors want on every deal that has financing involved. Basically, I'm just working to help strengthen your offer and make you stand out, especially in competitive markets. Now, if you're not working with me on a transaction, I encourage you to make sure that your loan officer is doing stuff like this on your behalf. There's really no reason not to. It seems small, but it can literally be the difference between your offer getting accepted and the seller's choosing someone else. I got my home that I'm in now because my lender wrote a letter about me and my wife and how solid our financing was. We made our offer at asking price with financing, and we beat out a cash offer for $10,000 above asking just because our lender called the listing agent and described the work he'd done to pre-qualify us. Ideally at this point, one of two things will happen. Your offer will be accepted or it's countered. A counter offer can be a really good sign that you're on track to a deal, but obviously accepted is a little bit better. I have seen people go back and forth with half a dozen counter offers sometimes. It just depends on the market and the particular property. But hopefully you land at that accepted offer eventually. Congratulations. That is a big step and you're on your way to closing. But there's still a lot of work ahead. What usually happens as soon as your offer is accepted is that you and your loan officer will discuss locking your interest rate. Interest rates change every day, sometimes multiple times a day. So when you lock your rate, the lender is agreeing to honor that specific interest rate for a specific period of time while you work towards closing on your purchase. Generally, we lock the interest rate right after you have a specific property and you're officially under contract. Now, the reason we usually don't lock the rate before then is that rate locks have an expiration date on them. Commonly, a rate lock period will be around 30 days for a loan, although you can get a longer or shorter period as well, but that just depends on the lender and the specific transaction. So let's say you find a house and you expect to close in 30 days, so you lock your rate before you're officially under contract. Maybe you're nervous about rates going up, so you want to secure that lower rate now, but then you submit your offer and the seller counters your offer, and part of that counter says that they want the closing to be 45 days out instead of 30. Your original rate lock may no longer last long enough to get you all the way to closing. At that point, you may need to pay for what's called a rate lock extension, which can add additional costs to the loan. So that's why we generally wait until the offer has been accepted and the purchase contract has been fully executed by all parties before locking the rate. Once the contract is fully signed, we know exactly when that closing date is, and so we can lock the interest rate safely. Now, before you lock or during the lock process, your loan officer should discuss all the interest rate options available to you, whether they come with points or lender credits, and help you understand the trade-offs to help you make that decision. What will also happen at this point after your offer's been accepted is your loan officer will officially submit the loan to the underwriters, whether this is at their own company or a third-party lender if you're working with a broker. Now, this includes them giving the underwriter a copy of your loan application, all those supporting documents that you submitted to them, a copy of the purchase contract, usually some tax documents, and maybe documents from the title, escrow, or settlement or closing company, depending on your state. And that closing company, you can choose the one you want, but in most transactions, one of the parties involved in the transaction, like a realtor, will suggest a company to use. Once your loan officer submits the loan to underwriting, you will wait to hear back from them. While this is happening, you'll also order your home inspection, and your lender will likely order the appraisal at this time as well. Now, in many cases, you'll be paying for both of those items, the inspection and the appraisal, so be prepared to swipe the credit card for these. Now, the inspection is more of a real estate process on the real estate side of the business. It's bringing in a professional or multiple professionals to determine what in the house is in proper working condition and what could stand to be repaired or may likely need repairs in the near future. They'll look at everything from air conditioning to tile and plumbing to windows and doors, and they'll write up a full report on their findings. Your realtor can then use this report to get quotes on any repairs or replacements the inspector suggests, and use this to go try and argue for a better deal on this purchase for you. Now, on almost every purchase transaction, there is a due diligence period that the inspection must be completed and approved within. Because of this, you generally want to order the inspection as soon as you're under contract. That way you have plenty of time to review the results, but you'll definitely want to consult with your realtor on that inspection. Now, the appraisal is a little bit different. The inspection is really for you. The appraisal is more for the lender. The main job of that appraisal is to make sure the home is actually worth at least as much as the purchase price that you're paying. And as I said, the appraisal is really a requirement from the lender. They want to make sure that if they're going to lend you a few $100,000, that asset you're buying is worth the sticker price. That way, if you default on the loan and they have to seize it and sell it, they'll at least be able to cover some of their losses. At the most basic level, the appraisal will either say the property is worth enough or it isn't. If it comes in low, it can kill the deal, but there are often several steps that can be taken to salvage it. The appraisal can also come back as what's called subject to, which means the home will appraise at a specific dollar value subject to certain conditions being met, often some repairs like replacing a roof or fixing exposed wiring or something of that nature. So in that area, the appraisal can bleed into kind of more of inspection territory. And the type of loan you're getting can influence this a lot too. Like if you're getting an FHA loan, the appraiser will have some more strict requirements that they have to follow that could lead to a subject to appraisal result. And then finally, the result that everyone hopes for on the appraisal, it could just come back with a value that is the same or higher than the purchase price on the contract. Now, at some point during this process, underwriting will come back with what's called an initial approval. The initial approval means the lender has said, yeah, we'll do this loan as long as these conditions are met. So they've reviewed that application and those documents and they say, yeah, everything checks out here. Now the conditions that underwriting gives here become your loan officer's job. It's usually very simple, providing some extra documents, having you sign a letter, getting the appraisal result that we need, getting homeowners insurance in place, things like that, making sure the taxes is paid, etc. Some conditions will also be for the closing company, if there are any specific documents that they want signed in that closing package, things like that. Now, ideally, if you have a good loan officer, your loan will come back with only a handful of conditions. Once all those conditions are cleared, underwriting will give what's called the clear to close, meaning we can go ahead and start getting the final documents ready for signing. And that clear to close, what's often referred to in the industry as CTC, is usually a green light to everybody that this deal's headed towards a safe and successful closing. As you get closer to the end of the loan process, you're also going to receive another important document called the closing disclosure. The closing disclosure looks very, very similar to that loan estimate that you received earlier on in the transaction. You can essentially think of it as an updated and more accurate version of that loan estimate. When the loan estimate was created, the lender may not have had final numbers for things like homeowners insurance, property taxes, title fees, prepaid interest, escrow deposits, rebates, things like that. But by the time the closing disclosure is prepared, the lender and the title or settlement company should have much more accurate information for you as far as what those final numbers are going to be. So the closing disclosure will show your final loan amount, interest rate, monthly payment, closing costs, and the amount of money that you're expected to bring to the closing table, which is going to be your down payment plus those closing costs. It will also allow you to compare the final terms of the loan against the numbers that appeared on your original loan estimate. Now, legally, you must receive the closing disclosure from your lender at least 3 business days before you sign the final loan documents. This gives you time to review everything, ask questions, and make sure the loan you're receiving matches what you expected and what you were quoted before. Now, that 3-day requirement can sound like something that might slow the closing down, but with many lenders, it's usually not a concern. Some lenders are able to issue that initial closing disclosure within the first day or two after the loan receives its initial underwriting approval. That means the 3-day waiting period can begin while the loan officer and the processor are still working on the remaining underwriting conditions. Now, they're able to do this because they happen to be a little bit better at getting some of those final numbers ahead of time. So by the time the loan receives that final clear to close, the 3-day waiting period may have already been completed. Now, the closing disclosure may still receive small updates as final numbers are balanced between the lender and the closing company. But before you sign, you should review the final version and make sure you understand the interest rate, monthly payment, closing costs, and the final amount you need to bring to closing. As you near your close of escrow, your lender and your closing company will coordinate on the closing date and time and the method. Some states and lenders will let you sign and fund the loan on the same day. Some require a wait. Some will let you sign virtually, while others require an in-person signing. So it just depends on your particular purchase and your deal. But the closing company will reach out to you to provide information on closing as far as where and when, the final amount that you'll need to pay at closing, for down payment and closing costs, and then they'll also provide the wire instructions on how and where to send the money via wire. Now, I have to give you some really important information here. Never trust wire instructions sent only by email. Independently call the title or settlement company using a verified phone number, a public phone number, and confirm the wiring information before you send anything. Now, your realtor will coordinate with you around this time to do a final walkthrough of the property. This is your chance to walk the home and make sure it's in the agreed upon condition prior to signing your closing documents. When the closing day comes around, you'll sign your documents and you will get a copy of them. The closing company will provide the documents to the lender for review. Then once they review and sign off, they'll give the closing company the go-ahead to release the funds to the appropriate parties and to record the transaction with the county. When the county confirms the transaction has been recorded, you are officially closed on your purchase. Usually at this point, your realtor will provide you with the keys to the home shortly after this happens. So congrats, now you're in your home. But that's not the end. The documents you signed at closing will contain a letter with your first payment instructions for your mortgage. So that'll include the amount and where to send it. However, the way things generally work today is that within a week or two of closing, your lender or your loan servicer will reach out to you probably via email, sometimes via phone and mail as well, with instructions on how to set up an account in their online portal and to set up things like automatic payments for your mortgage going forward. Now, one thing that's important to note is that in most cases, when you close on a new mortgage loan, your first payment is not due right away. What do I mean by that? Well, mortgage payments are generally due on the first of the month, but you usually skip or miss that first month after you sign. So if you sign on July 15th, you will not make a payment typically on August 1st. Your first mortgage payment will instead be due on September 1st. Now, that doesn't mean you're truly skipping a payment. You pay for that interest at closing, but you do get a little bit of a reprieve there. Now, you'll want to confirm that first payment due date with your lender and your loan officer just to make sure you never miss a mortgage payment. So that's the basic workflow of what it's like to get a mortgage and buy your first home. Now, every single mortgage is unique. It's kind of like a fingerprint. So the specifics of your transaction will vary a bit, but this is a good depiction of the general process and the steps involved. As you can tell, it is a little complicated, but people get through it all the time, and that's what a good loan officer and a good realtor are here for, is to help guide you through that process. Now, as always, if you're thinking about going through this process yourself, I would love to be a part of it and to help you. You can use the link in the description down below to book a call with me so we can discuss your personal situation. Now, as always, I really appreciate you guys watching this. And if you don't mind liking and subscribing and sharing this with somebody else that you think might find it helpful. And until next time, take care.